Welcome to another session for the CISI Level 2 Fundamentals of Financial Services qualification. This is session number 14 and we're going to be looking at bond prices and yields. So we're carrying on with the bonds chapter, which is chapter 5 in the workbook. And I am joined again, as I was for session number 13, by Simon Metin, who is a relationship manager at the London Stock Exchange Group. Hello again, Simon. Really good to have you here. Thanks very much for joining us again.
Thank you.
Excellent. So Simon is going to be our practitioner for the session, and we'll be asking Simon a few questions about bond yields and bond prices as we go through. So what this session will focus on, we're going to be looking at what influences bond prices. So we've mentioned a bit about bond prices in the previous session, but we're going to go into quite a lot more detail in this one. And we're also going to be looking at how the flat yield of a bond is calculated. So in the session we were looking at equities, chapter 4, the chapter before this, we spoke about dividend yields, so which was the return on investment from shares. We are looking here in this session about the flat yields of bonds, which is basically one way of measuring the return on investment from bonds as a financial instrument for investors. So we're going to be looking at that, how that's calculated, and there will be some opportunities for you to practice that via the Google Classroom test that will be there for you. So before we get on to the session at large, we just wanted to have a quick recap on what we covered off in the previous session, primarily about the terminology around bonds. So what I want you to do is actually, if you pause this this recording as you look at this slide, and what I want you to do is just kind of write down the definitions as you can remember them for 1, the nominal value, 2, the coupon, 3, the redemption date, 4, the stock name, and 5, gilts. So just what I want you to do is write down your definition from what you can remember from the previous session at what each of those 5 things is in relation to bonds. So if you pause that video now, and then we'll reveal the answers for you. Okay, so hopefully you've written those down and you've got some answers to those. So the first one was the nominal value. So this was the original amount of the bond purchased when it was originally bought, and it's the amount paid back to the bondholder at the redemption date. So the coupons or the interest are calculated based on this value. So there are some other names that are given to the nominal value. So you might also see this called the par value, the face value. Remind me, Simon, are there any others I've missed there? Nominal, par, face. I think that's
everything. Yeah,
it's most of them. Yeah, I just couldn't remember if there were any other terminologies given to nominal value. So yeah, so that's the original amount of the bond when it's purchased, and that remains fixed in terms of, unless you buy specific types of bonds where the nominal value changes. Generally speaking, that remains the same. So at the end of the life of the bond, at the date that it redeems, the nominal value is paid back to the bondholder. The second term was coupon. I think we've kind of already hinted at what this means. This is basically the other term for the interest rate paid to the bondholder. So this is the amount of interest that's paid, and that's based on the nominal value. So if it's 5% interest, that 5% is calculated on the nominal value of the bond, and that is then paid to the bondholder. And that's normally paid every 6 months or every half year, generally speaking. Then we have the redemption date, and this is the date by which the bond matures and the nominal value is paid back to the bondholder. So the original amount that was lent, because if you remember right, remember bonds are basically loans. So the amount that was lent, so the value of the bond or the nominal value, that then is redeemed and therefore is paid back to the bond holder. And the redemption date on a bond can be 5 years, 10 years, 15 years, basically anything over a year in length. But some of them are quite long, some of them are shorter. And remember, we spoke, I think we may have even spoken about kind of perpetual bonds that used to be in existence that had no end date. I think the UK got rid of most of those, and they were really kind of mainly used to fund wars in the past, and there was no redemption date for bondholders. But as we said, a lot of those have been paid back by the UK government. Then we've got the stock name, and that's basically the name of the bond, which usually includes the name of the issuer, the coupon rate, and the maturity date. So generally speaking, that will hold, or the stock name will include the name of the company or the government, if you like, that's issued that bond. And finally, gilts, if you remember from our conversation in the previous video recording, that's the name given to UK government bonds, or the nickname that's given to UK government bonds. And that's because the original paper certificates on which they were issued had a gold edge. So we would call those gilt edge securities. So the abbreviation of that is a gilt. So they are UK government bonds. Okay, so that recaps on what we looked at briefly in the previous session and the key terminology around bonds and what some of those mean. So in this session, as we said, we're going to look at bond prices, and we're going to look at yields and return on investment that is taken or given to bondholders from those bonds. So the first thing we're going to look at is how bonds are priced. And if you remember previously, that we kind of spoke about the convention of how bonds are priced. And Simon, I wonder, can you give us a kind of a bit of a recap on some of the things we said in the last session about how bond prices are quoted to investors?
Yeah, sure. So I mean, bond prices are done relative to the nominal amount that you're going to be getting at the end of it, at maturity. And by convention, it's done per 100 of the nominal bond in whatever currency you're talking about. So if it's in Great British pounds, you're talking about how much it would cost you to buy £100 of the notional of that bond. And so because it's priced in terms of per 100, you're thinking more in terms of percentages then, and it just makes it a bit easier to think about bonds relative to one another.
Right, and would I be correct in saying, Simon, that when a bond is issued, it's always issued at, it costs you £100 to buy £100 of that bond, so to speak?
Not always, depending on really market conditions and the underlying T's and C's of the bond.
Right.
But in general, you'd ideally have them priced at par value. But I mean, for example, with interest rates going up, you might find that a bond is being issued with a coupon rate that's very low, that might cause investors to not actually want it. So its price goes down purely because of supply and demand issues.
Right. Okay. Good. And that kind of brings us on to what influences bond prices. So you mentioned there about interest rates being the kind of key influencer on the price of a bond. Can you kind of explain to us a little bit about how that kind of works? What influence do interest rates have on bond prices?
Sure. So I mean, the way that I think about interest rates and bond prices and all of these things, I think of it in terms of the return that you're expecting from that bond. So if you have a bond with a coupon rate of 2%, and current interest rates in the market are 2%, then you'd expect it to be priced at par, or or possibly slightly above par. But if interest rates were to go down all of a sudden, then this particular bond that still has that 2% coupon rate has a coupon rate that's currently above current interest rates. And that means that investors will look at that and think, this has got a much higher, semi-annual, annual coupon that I'll be getting. It's therefore worth more. And because of that, despite the downward trend in interest rate in the market, the price of that bond will go up. So the two are inversely related to one another.
Right, excellent. Okay, thank you. So just kind of recapping on just kind of consolidating some of the things that Simon has just said. So one of the key things to bear in mind about bonds is that they, just like shares, they can be traded. So just if you buy a bond from issue, when it's issued by the borrower or the company or the government that wants to borrow that money, when they issue those bonds, it's not always that a bondholder will keep that bond until it matures. You might trade them. So you might sell them before that maturity date comes up. So if you've got a bond with a maturity of 10 years, you get the bond when it's first issued. So you hold that bond, but then it might be that in 2 or 3 years' time, you decide that actually I need the money back for some reason, or interest rates may have changed and you think, right, I'm going to get rid of this bond. I don't want it anymore. And therefore you try to sell it. So that can have an influence. If you then want to sell the bond, the price of that bond that you get from the buyers, so based on supply and demand, that may change in relation to the nominal value or the original amount that was paid to purchase that bond in the first place. The key thing to remember is that the nominal value for bonds that are fixed won't change. So the bondholder, whoever holds it, will always get that amount back when the bond matures, unless it's a certain type of bond where that might change. But most of the time they're going to be fixed. So the nominal value will always be the same. However, the price that someone pays to buy it from another investor may be different from that of the nominal value or the original amount of the bond, the amount that the bond was worth when it was originally sold, and the amount that the bondholder gets back. So that's something that you have to be aware of. So when you trade them, the bond price may be higher or lower than the nominal value of that bond. And as Simon has said, it's interest rates that can have an influence on that. So Simon had said about the fact that bond prices are quoted as the cost per £100 nominal. And generally speaking, that's when it's first issued, it will cost you £100 to buy £100 of that bond. But as we said, if you come to try and sell them before it matures, interest rates can have an impact on whether or not the price that you receive for that bond or what someone's willing to pay for it is the same as the nominal value. It might be higher than the nominal value. It might be lower than the nominal value. And as Simon said, it depends on the interest rates that there are at the time at which you come to sell it. And those interest rates in relation to the coupons that your bond is offering at the time. So as Simon said, there's an inverse relationship between interest rates and bond prices. What you generally tend to see is that if interest rates have gone down, okay, so it's offering a level of interest that's kind of lower than the coupons on your bond, you would then expect that the bond price would go up from the nominal value. Okay, so the bond price may then increase. And then the same is true if you reverse that round. So if interest rates go up, so interest rates are higher than the coupons that your bond is offering, it's likely that your bond will go down in price. And sorry, Simon, just recap again why that happens. So why that's just explain to us again how we've got it tied up.
Yeah, I mean, the reason why that happens is purely down to the investor's view on, reward that they're looking to get. So, if interest rates were to go up, an investor can look elsewhere for any other kind of asset, whether it be a different kind of bond or whether it be equities or commodities or something that could potentially offer a higher rate of return. And so if interest rates were to go up in this case, then you'd expect the price of bonds to go down to reflect the options that these investors have to look elsewhere.
Right. Okay. Excellent. Thank you. So to kind of summarize Simon's point there as well, we've got an example up on screen that kind of shows you why this inverse relationship exists, and it reflects what Simon is saying there. So if we take the top example, so as we know, if interest rates go down, there's this inverse relationship. If interest rates fall, bond price will go up. So if we're a bondholder saying we own a £10,000 nominal bond, which is 5% Treasury 2022. So it matures in the year 2022, pays 5% coupons, and it was issued in 2018. So the bond has got a 4-year life on it, if you like, or 4 years till it matures. So we're the bondholder, we hold that bond. If in 2020, so 2 years after it's issued, we now want to sell it as the bondholder, we want to get rid of it, but interest rates are now at 4%. So if you compare that to the coupon of your bond, it's 1% less. Okay, so if interest rates are 4%, but my bond pays 5% coupon, it's likely that if I want to sell my bond and get rid of it, then you're going to have a greater number of people that want to purchase that bond because it's offering a better return than possibly other financial instruments or even other new bonds that are now being issued, because interest rates have fallen and coupons will probably more likely reflect that lower rate of interest. So what we would expect to see is that the bond price will go up because my bond, our 5% coupon bond, is offering a better rate of return, and therefore the demand will probably be higher for that as a result. So in this case, what we see is that the bond price increases from the £100 per £100 nominal that it was when it was issued, and it's now gone up to £110 per £100 nominal. And that's purely because my coupons on my bond, on our bond, are 1% higher than the prevailing rate of interest, and therefore it's more appealing. The rate of return is higher, probably than other financial instruments, but certainly probably than other bonds that were being issued at the current time in 2020 when we're looking to sell it. So that now means if the price of the bond is £110 per £100 nominal, that now means that we can sell the bond for £11,000. The nominal value is 10,000. So we would have made £1,000 on that. We would sell it, and that was as a result of the interest rates going down, and therefore the price of our bond going up because it is more appealing to the investor. And if we take the reverse scenario where interest rates might go up, again, we're the holder of that £10,000 Treasury bond, 5% interest. Again, same scenario. We purchased the bond in 2018, has a maturity date of 2022, and then in 2020 we want to sell it. So 2 years into the life of the bond, and this time interest rates have gone up above the coupon rate of our bond. So in the previous example they went down, but this time interest rates are 6%, so 1% higher than the coupon rates that we are offering on our bond that we own. As a result, our coupon is offering a lower return on investment, if you like, compared with maybe new bonds that are being issued or other possible investment options for those investors. Therefore, to make it appealing to investors to buy, we would have to lower the price of our bond. Okay, so in this case, what happens is the bond price decreases from the £100 per £100 nominal when it was issued to now £90 per £100 nominal. That now means that we sell the bond for £9,000, which, as you can quite easily see, is £1,000 less than the nominal value of the bond. So therefore, we've lost £1,000 if we were selling that bond for that 9,000. So this is why interest rates have an impact on those bond prices, because as Simon said, it needs to become appealing for investors to buy them if you're looking to trade it. So if interest rates have changed in relation to the coupon being offered on the bond, then that will have an impact on the price of that instrument when you come to try and trade it and try and sell it. Is there anything that you'd like to add to that, Simon? Or
I suppose the only other thing to add is that aside from what the price that you're selling at, the other thing you should take into account is if you bought that bond a year ago, you would have also taken into account two coupon payments. So even though you might be posting a loss in terms of capital gains, capital losses, you should also include what you've taken from that coupon and how you've reinvested that. So, I mean, there's a lot of factors that come into play, but the bare bones of it is, what you're talking about too.
Yeah. So what you're saying there is that an investor has to make that decision about whether it's worth selling it. It's not just based on that price, as you say. They will have received coupons for however long they've had that bond for. And equally, I guess, for the investor that's looking to buy that bond, they have to take into consideration the coupons that they will probably receive over the rest of the time that that bond is alive, if you like, or before it matures. So if they were to buy it for more than the nominal value, because the price of the bond has increased, then therefore they may look at the coupon rate or the coupons that they will receive before that bond matures. So as Simon says, there are things that investors would need to take into consideration above and beyond just the bond price changing, about whether or not it's a good thing to sell it or not, or to buy it. So it's a really good point. Thanks, Simon, for bringing that up. Absolutely. But ultimately, I think it's just important to have an understanding of the notion as to why the bond price will change when interest rates do change. It's remembering that there's that inverse relationship. So whatever interest rates are doing in comparison to the coupon of your bond, okay, then your bond price will have there'll be the opposite effects on your bond price. So if interest rates go down below the coupon of your bond, it's likely that your bond price will go up from its nominal value. And equally, if the interest rates go up above the coupon rate, then the price of the bond will go down probably below the nominal value of that bond. So that just kind of summarizes that relationship between interest rates and bond prices. So the other thing that we wanted to look at in this session was bond yields. And as we said, bond yields, if we compare that to dividend yields, as we looked at in the equity section, dividend yields were calculated by using the dividends paid out on those shares, and you divide that by the share price at the time. So that gives you the return for shareholders based on the dividends that are paid out. So that potentially regular income, because as we know, dividends aren't set in stone. Coupons are a bit more certain for bondholders, because they should be, most of the time they're fixed, and unless there's a problem with the company or the government that you've lent the money to, you should get paid those interest payments. So bond yields, very similar to dividend yields. It's a way of measuring return on investment for bondholders. Simon, is there a relationship between bond prices and bond yields? So
yes.
What is it? Is there
Yes. So I mean, the two are sort of intertwined, and I mean, fundamentally, I mean, if you're looking at equities and like as a sort of contrasting example, the price of an equity is equivalent to the present value of all of the dividends that you're going to be receiving in the future. And I mean, because markets have evolved and there's been changes, I mean, there are changes to that, but fundamentally that's true. The same is true for bonds, and the price of a bond is equal to the present value of all of the cash flows that you're going to be getting in the future. So that will take into account the coupons, all of the dates, and then the final lump sum that you're getting when the bond matures. And how you determine the present value is that you need to have some sort of rate of return. And in this case, you refer to the yield, which, I mean, there are different kinds of yields, but the yield is a rate of return that enables you to discount all of these future cash flows so that it equals the current price of the bond. And so you need one in order to calculate the other. And if you have one, you can calculate the other, going both ways. So if yields were to go up, investors are demanding a higher rate of return. So you'd expect the price of the bond to go down. So it's a similar vein to interest rates, the way that the two are related.
Sure. Yeah. So you've got this again. You kind of there's an inverse relationship between bond prices and bond yield. So if the bond price goes down, the yield goes up. If the bond price goes up, the yield goes down. So you're right. So the bond yield pretty much does. It's got the same relationship with bond price as interest rates does with bond price. It does the same thing, doesn't it? So if interest rates go down, bond price goes up, yields go down. So it does the interest rates, and the yield will do the same thing in relationship to the bond price, so to speak. Yeah, and that's a good explanation there, Simon, about how that kind of works. So I mean the coupon rate and the yield, unless the bond price stays the same as when it was as the nominal value. So unless unless the bond is being traded at £100 per £100 nominal, the yield will be different from the interest rate or the coupon rate on that bond. But if the bond is being traded for the £100 per £100 nominal, the coupon rate and the yield will be the same. Okay, so whatever the coupon rate was or is on that bond, that will be the same as the yield. So if it was a 5% coupon, the yield would be 5% if you were paying the £100 per £100 nominal for the bond, as it would have been when it was issued. It's just if the bond price changes, then the yield will be different from the coupon rate.
Yeah.
So the way the bond yield is calculated is you take, well, the flat yield in this case, as Simon said, there's a number of ways that bond yields can be calculated, but the flat yield that we're looking at here, you take the annual coupon for the bond and you divide that by the market price. So we're talking here about the amount it costs, or the amount that has been paid to purchase £100 nominal of that bond. Okay, so if the bond price has gone up or down in relation to, because of the change in interest rates, you're either going to have the market price of £100 per £100 nominal, which it would have been when it was issued, or that price would have gone up above the £100 or below the £100 if the bond price has decreased. And then you work that out as a percentage to give you that percentage return, as we did with our dividend yields. But instead of using dividends and share price, here we use our coupon and our market price of the bond.
Exactly.
So
it's identical in terms of its calculation.
Yeah, absolutely. Yeah, it's just, as you say, it's exactly the same. It's just that you, instead of using your dividends, you're using your coupons, which is kind of that regular, hopefully regular return that the shareholders and the bond holders are getting. So absolutely. So and as Simon said, there's this kind of, again, there's this inverse relationship between bond prices and yields. So as Simon said there, the bond yield does the same things as interest rates in relationship to the bond price. So as bond price goes down, the yield of the bond will go up. So and equally, if the bond price goes up, the yield will go down. So and what we're saying is the yield will go up in relationship probably to the coupon rate. So if the yield, so if the bond price goes down and below the nominal value, and then the yield goes up, that's normally, it goes up in relationship to the coupon. You would probably likely see that, and the same would, the opposite would occur if the bond price increases. So yeah, there's this inverse relationship again, and kind of we'll just kind of show you again how that, using examples of how that would work. So if we take that example that we had before of a £10,000 nominal bond, 5% Treasury, 2022, issued in 2018. So exactly the same scenarios we had when we're looking at how interest rates can change bond prices. So in 2020, I want to get into that bond. Interest rates have gone down to 4%. So again, 1% lower than the coupon rate on the bond. And as we know, that means that the bond price will go up. So in the same example we had previously, that means now that the bond is sold for £110 per £100 nominal, and therefore someone buys that bond for 11,000, so £1,000 more than the nominal value of that bond. Now, the original yield when the bond was issued would have been the same as the coupon, so it would have been 5%. Okay, but in this case, if we use that calculation of taking our coupon and divide that by our bond price, we're going to have our 5% divided by the 110, times that by 100. That now gives us a yield of 4.54%. So it's no longer the same as that coupon rate of 5%. Our yield or our return is going to be 4.54. So if you look at it here and take those relationships that we've got here, so interest rates down, bond price up, bond yield down. The interest rates have gone down here in relationship to the coupon. Okay, so 2 years after the bond has been issued, our interest rates have gone down below the coupon rate of 5%. So therefore, our bond price will go up because our bond looks more attractive to investors. As a result, our bond price is no longer £100 per £100 nominal because the bond price has actually gone up. So it's now £110 per £100 nominal. Therefore, if we work that out as the calculation for the flat yield asks us to do, our yield now is 4.54%, which is lower than the original coupon rate we had of 5%. So there's that inverse relationship between bond yields and bond prices, in the same way that there's that inverse relationship between interest rates and bond prices. Okay, so that kind of just demonstrates that there. And then again, if we take the other scenario where interest rates go up instead of down, so again, same scenario, same bond, but this time interest rates are at 6%, whereas our coupon rate for the bond that we own is 5%. We want to sell it. This time our bond price goes down because our interest rates have gone up above in comparison to our coupon rate. So now the bond is sold at £90 per £100 nominal rather than the £100 per £100 nominal. So the bond, the new investor buys the bond for £9,000, so £1,000 less than the nominal value. What we should then see is, because our bond price has gone down, we should see our yield go up above that coupon rate of 5%. So if we do that calculation, which if you take our 5% coupon, divide it by our new bond price of £90, times that by 100, that now gives us a bond yield of 5.55%. So it's gone above that coupon rate. So again, bond yield has gone up above the coupon because the bond price has come down below the nominal, and that's because those interest rates have gone up. So the new bonds that are being issued or other financial instruments that you might invest in are probably going to give you a better rate of interest or return. So therefore, the yield of the price of the bond goes down, but the yield, the return for that investor, goes up as a result. Anything, Simon, anything that you want to kind of add to that at all?
Yeah, I mean, this is very, very useful stuff to understand the fundamentals of bond math. Just it's worth bearing in mind that this only really applies to the most we call vanilla or simple kinds of bonds. So government, default free bonds, assuming that you're not really including any other spreads or any other reasons that an investor would want to assess the risk and return attributes of the investment. Things do change when you're looking at corporate bonds, because you have to incorporate spreads, and then things also change with like floaters, because even though interest rates are going up, then the coupon of that bond will go up as well. So the relationship isn't as clear as you'd once think. So while it's good to understand these fundamentals, it's just also worth thinking about what might happen with other kinds of bonds. I mean, purely out of the scope of this this session, but it's just always worth thinking about the broader market.
Yeah, it is a really good point, and something that we've kind of hinted at is that, as you say, this applies to bonds where coupons and nominal values are fixed, nothing changes. Whereas there are lots of different bonds out there, as you said, you've got kind of floating rate bonds where the coupon rate will be linked to a rate of interest and can fluctuate. And generally speaking, as you say, most kind of conventional bonds, conventional government bonds will act in this way. but other types of bonds, as you say, of which there are quite a few out there with and work in very different ways, that you have to take other factors into consideration. But yeah, as you say, for this, for the level 2 qualification, it's kind of understanding that this is kind of generally the way things work.
Exactly.
But as Simon, but as you say, Simon, you have to, in the real world, there's all this other stuff going on, different types of bonds, and also, as you'd said, this is kind of one way of working out a yield. There are other ways that yields can be calculated, which take into account different factors. So, and there are different bonds out there, as Simon has said as well. So, Simon used the term vanilla, which is kind of that kind of generic, straight up, standard, conventional. That's kind of the phrase that you use for that, isn't it, Simon?
Exactly. Yeah, that's just more what do you call it? Like just corporate terminology that we use that just makes it sound like it's the simplest of the simple. Even though a lot of people do like vanilla flavored things, but it's fine.
Yeah, I was going to say, do you think that's linked to vanilla ice cream being the standard kind of standard?
It's pretty much,
Yeah, absolutely. Yeah. So it's a really good point that Simon makes there, is that actually, when you come, if you're working with bonds and securities like that, then you kind of you'll see all of these different types of bonds that are out there, and they're not always just as straightforward and conventional as this, but generally speaking, this is how bonds will work in terms of the pricing of yields.
Yeah, I mean, if you can understand these concepts, these very fundamental concepts, you'll be able to apply it to whatever kind of fixed income instrument. It's just getting this bit down that seems to throw a lot of people.
Yeah, and I mean, the thing also to remind everybody is that in the exam, what you will face is you will be asked, generally speaking, most students come across in the exam a question where you have to calculate the flat yield of a bond, and so you don't necessarily need to understand this relationship with yields. You just need to be able to calculate the yield. So as long as you've got the right figures in the right place, you'll be able to do that. But as Simon says, it makes sense for you to kind of understand these relationships and how the dynamics works. And the reason it's in the bond yield relationship is an interesting one, and why kind of knowing this helps is that if in the exam you've got a question which, so say in this example we've got up on the screen with the inverse relationship between interest rates have gone down from the coupon rate, we know that because interest rates have gone down, have gone up in this case, the bond price will have gone down, and because of that, we know that the bond yield should have gone up in comparison to the coupon rate on the bonds. So we know that the the yield should be above the 5% mark. Now, it could be in the exam you've got 4 options for your answers because it's multiple choice. It might be, and I'm not saying that they're always going to be this kind with the questions, but it might be that 2 of those answers gives you a yield figure or yield percentage of lower than 5%. So you can kind of automatically discount those because it's like, well, I know that the bond price has gone down, so therefore the yield would need to go up above that coupon rate, so I can discount those 2. So if you've got unstuck with or you become stuck with the calculation, you can't remember it, then sometimes in these questions, understanding that relationship can help in selecting the right answer. But as Simon said, there's a much more there's a more important reason to understand that is this concept is because it will help when you look at if you come to work in these areas and generally understand how these things work. So it's important to be able to do that. Okay, and then finally, just to kind of summarize with that, then what we've spoken about is quite simply that bond prices are susceptible to movements if you trade them, and that's movement in interest rates can change the price of a bond if you come to sell it or buy them. And for the yield to be attractive to invest in, it needs to remain competitive with the return available on alternative instruments that you might be able to purchase at that moment in time. So it's important to remember that relationship between interest rates, bond prices, and yields. So just remember that if interest rates go down below the coupon rate of your bond, below the coupon, then the bond price is likely to go up above the £100 per £100 nominal value. That also will have a knock-on effect to the yield. The yield will be a percentage below the coupon value. So remember that interest rates and bond yields will do the same thing in comparison with the bond price. So in this case, interest rates down, bond price up, bond yield down. And then the reverse is true. If interest rates go up above the coupon, the bond price will go below the £100 per £100 nominal mark, and the bond yield is likely to go up above the coupon rate percentage there. So it's just remembering those inverse relationships, and the reason is that the investor will want to be compensated, if you like, for the fact that they can purchase or they can buy different investments that will probably give them a more competitive rate of return. So therefore, bond prices will have to change accordingly. Or it might be that the bond you own gives a better rate of return compared to those instruments that other people can buy at that moment in time. So therefore, things have to adjust to make it appealing to purchase. Is there anything, Simon, that you, before we finish, anything more that you want to add there that we haven't spoken about, or you think that's relevant or important to bring up?
No, I think that's we've underlined the fundamental concepts and the the flat yield and things. Yeah, I think that should cover everything.
That covers it there. Brilliant. Thank you very much. So if you there is another multiple choice test on the Google Classroom where it actually asks you, I think there's 10 questions in there asking you to calculate some bond yields. So make sure that you know the calculation. Remember, it's taking your annual coupon, divide that by the bond price, so the price per £100 nominal of that bond. You then times that by 100 to give you your percentage yield. So please do have a go at those on the Classroom. And it just remains for me to say thanks again, Simon, for joining us for another session. It's been great to have you here. Thanks very much for your insight and your expertise. And hopefully we'll see you again soon at some point.
Yeah, no worries. No, it was a pleasure. Thank you.